What is going on, everyone, and welcome back to Financial Footprints Podcast. My name is Colin Hayes. I am your host, and in today's episode, a little bit of education here because I'm going to talk about something called asset location. I like to call it tax diversity. The reason that this is important is because when you understand that different accounts are taxed different ways, and whenever you build diversity amongst your taxes with these different types of accounts, it is a very powerful thing for your money and for your financial planning. It helps you understand where you should hold different types of investments. I'm not talking about how do you decide between investing into the total US market fund versus an S&P 500 fund. I'm talking about where you actually put that investment. Because taxes are very critical for your financial plan, especially as you approach and are in retirement, but even throughout your entire financial journey, because taxes play that crucial role, it is important to understand the power of tax diversity. So what is asset location? It involves using different accounts to leverage the different tax advantages that each of them offer. This would be benefits based on when you contribute, maybe the growth of that money, the distribution. So when you take money out, maybe that's where the benefit is. But each of these different three, and then a bonus for, but the three tax locations for your investments, each of them have their own benefits and tax implications. And like I said, when you put these together and you build diversity amongst your taxes for your investment accounts, it can be very powerful throughout your financial journey. So the first place of asset location is what is called pre-tax accounts. Pre-tax accounts. This is also known as maybe tax-deferred accounts. So what happens is with the money that goes into these accounts, so the contributions that you make in pre-tax accounts, you get an immediate deduction on your money. You get to deduct that contribution from your taxable income. And when you put that money into these accounts, the word tax deferred comes into play because as the money grows, you maybe get dividends. It is all tax deferred. It is deferred. It is pushed out into the future. Now, when the taxes come into play is at distribution. So when you take money out of these accounts, because you didn't pay taxes going in, because you didn't pay taxes on the growth of your funds, you will pay ordinary income taxes on distribution. So pre-tax accounts, this is one type of asset location. This would be things like your traditional 401k, your traditional IRA, SEP IRA, solo 401k, simple IRA, a traditional 403b. These are accounts where, again, put money in, tax deduction. Growth is tax deferred, but when you take the money out, everything, your contributions plus earnings, all of that money is taxed at ordinary income. The reason that these are important, the pre-tax accounts, is because they offer immediate tax benefits from your contributions. You contribute $20,000 in the year to your traditional 401k, you get an immediate $20,000 deduction, not credit, but deduction from your taxable income that year. The next type of accounts are called post-tax accounts. Post-tax accounts. What these are is the contributions going in. In this case, they are not deductible. You've already paid taxes on that money. So it's not like you get a deduction on it when you contribute. You've already paid taxes, so there's no tax benefit going in. But the money that grows over time in this account, as long as it stays in the account, it is tax-free. Dividends, earnings, etc. It is tax-free. So that's nice. But here's the benefit of post-tax accounts. When you take the money out, there are no taxes on your contributions or your earnings. So distributions are tax-free. This would be accounts like a Roth IRA or a Roth 401k, Roth 403b, post-tax accounts. These are important because when it comes time to take money out, usually in retirement, and you take money out of your Roth IRA, for example, it doesn't show up on your tax return. You're not paying taxes on that money. There's no ordinary income taxes on that. So those are what is called post-tax accounts. And then the final third one here, and then the bonus fourth, but the final third one here is what is called taxable accounts. These are accounts where when you contribute money, just like a post-tax account, when you contribute money, there's no tax deduction. You can't deduct your contributions. You've already paid taxes on that money. Then the growth of that money, you also pay taxes on those. And then when you take money out, you will pay capital gains taxes on that money. So why is this even good? I pay taxes going in, I pay taxes as it grows, and then when I take money out, I pay taxes again. So why is this good? Because there's something called short-term versus long-term capital gains. If you've held shares of whatever you're buying for more than 1 year, greater than 1 year, you will pay the gains taxed at long-term capital gains. And those are more favorable, lower tax percentages than if you were to sell that and it only held it less than 1 year. So let me say it this way. If you buy shares of stock XYZ on February 17th of 2025, and then June 16th of 2025, so just less than 1 year, you sell it for a $5,000 gain, that entire $5,000 will be taxed at short-term capital gains rates, which is the same as your ordinary income rate. So wherever you fall on the ordinary income rate, your marginal bracket, that is what you will pay for your short-term capital gains on those earnings. The flip side of that, let's say, for example, you were to buy shares of XYZ on February 17th, 2025, and then you didn't sell those shares, you held them until 2028. More than 1 year passed when you bought them. Let's say you sold those for a gain of $5,000. Same as last time, but this time you held it for longer than 1 year. Well, in this case, you get to pay what's called long-term capital gains. And long-term capital gains have different tax rates. They don't pay ordinary income taxes. You pay long-term capital gains taxes either at 0%, 15%, or 20% rate, depending on your total taxable income. I'll leave a link down in the show notes below that you can go look and see what's your taxable income. Where do I fall in? Either 0%, 15%, or 20%. So that's very powerful because potentially with really, really good tax planning, you might be able to pay when you take that money out in retirement on taxable accounts, even though you paid taxes going in, even though you paid taxes on the growth of those funds, you might be able to even take it out, those capital gains, as 0%, or even 15%, or even 20%, which is more than likely, potentially, depending on where you fall, more favorable tax rates on your earnings. So why are taxable accounts important? Because pre-tax accounts and post-tax accounts more than likely will have early penalties if you take money out that has not been taxed yet before a certain age, or they have contribution limits. But with a taxable account, there are no contribution limits. You can put in $500,000 a year, $500,000 a month in taxable accounts. There's no contribution limits for the year. Also, if you're holding those funds for longer than 1 year, you get those more long-term capital gains, more favorable rates than your income tax rate. So that's very, very powerful as well. And then the fourth bonus account that has the greatest tax benefit of them all, this is a triple tax benefit account. HSA, Health Savings Account. This is where money going in, the contributions you make are pre-tax, the growth of your funds are tax-free, and for qualified medical expenses, when you take money out, you don't pay taxes on that either. So you can get money into the HSA tax-free, it'll grow tax-free, and then if you take distributions that are qualified medical expenses, and there's a whole different episode about this, qualified medical expenses, the distributions you take can be tax-free also. So triple tax benefit. No tax going in, no tax on growth, no tax on the way out for qualified medical expenses. So Account type diversity, asset location, tax diversity. You have pre-tax accounts, post-tax accounts, and taxable accounts. And then some people might qualify for HSAs with a triple tax benefit. When you put all these three together and you hold the right investments into them, you want the highest growth in your tax-free, right? Because you don't care about capital gains. Maybe it's good to have a little bit of all three so that when it comes time to pull out money in retirement, you can take money from pre-tax accounts. Yeah, you're going to pay ordinary income taxes, but maybe you don't need a lot off your living expenses, and you can actually take those out at a very low tax rate. Or maybe when time comes to retire, you have large capital gains and you have low income years, you can start pulling capital gains, earnings in your taxable account at 0% rate and pay no taxes on your earnings. But it's all about diversifying your accounts and doing the right asset location. You can improve your tax efficiency. So utilizing the right investments in the right asset locations will help with your tax diversity, and at the end of the day, will help improve your tax efficiency and your financial planning. My name is Colin Hayes. This is the Financial Footprints Podcast, and I'll see you in the next episode. Goodbye.